Good day, fellow investors. The Fed has recently downplayed risks in their meeting, but I have been investing since 2002. And also, when I was researching for my Ph.D., there is a huge discrepancy between the sentiment related to short-term news and the development of long-term fundamentals. And that's exactly what I want to discuss today. Discuss the current Fed actions, plans, and predictions versus reality and what it might lead into given the long-term fundamental risks, and I'll also give you my prediction for the market. Of course, the Fed didn't cut rates. Trump immediately reacts that the rates need to be down, down, and down, but then everyone from the politics there intervenes, saying how the Fed is independent, Trump is allowed to comment but not influence. However, now the Fed is saying that the economy is not going to grow at 2.5% as many expect, just 1.7%. When it comes to the Fed and politicians, it's their job, Jerome Powell's job, to say everything is good. Imagine that Powell comes one day, I don't know, he's pissed off, had a fight with his wife, whatever. He comes and says, the risks are huge, we are likely going into a long-term recession, the stock market is overvalued, there is too much debt, this is not sustainable and the debt market will crash, US will default, bad demographics, higher inflation on tariffs. If he comes like that and just discusses the risks, actually, what would happen to the stock market, to economy, foreign investments? Everything would crash. And that's why we need to discuss the Fed and always have this short-term politics perspective, media sentiment, and long-term fundamental perspective. Because if you just look at 2021, Powell was saying that all this inflation is just transitory, it will pass soon, no worries, and then a year later inflation was at 8.5%. Also, their projections now are always so linear, no shocks, no nothing, but in reality, if you look at things, there are always shocks around the corner, be it inflationary, be it whatever. We have the projection for monetary policy going forward, 2 cuts projected this year, then a little bit more, and then Fed rates stabilizing at around 3%. But then I have just to show you the long-term, short-term discrepancy, I've just used the 2021 economic projections by the Fed. And look at this, inflation was supposed to be 2% for the last 3 years. We haven't seen 2% since 2020. That is how worthy are the Fed's projection. And then again, look at their projections for interest rates in 2021. So a little bit up, and then longer run only, it was supposed to be 1.5% in 2024. Longer run only at 2.5%. We are now at 4.5% and we have seen 5.5 here. This is the Fed's projection. So you always need to take those with a ton of salt because that's simply their job to lie a little bit or to discuss the situation from the best possible long-term influence confidence perspective. Because if we look at executive confidence, then Powell knows that he needs to increase confidence because according to Michigan University, consumer sentiment index is going down, 5 to 10 year inflation expectations are now up. People now think that there will be inflation for longer, and that also skews investments, pricing, spending, and whatever. And also, there is the dimmest outlook for personal finances on record since the record started in 1970s. And then again, if we look at those inflation estimates, we don't know. If there is a recession, there will likely be an easing in inflation that will allow the Fed to lower rates and then help again. But then you have a recession. So what's more important, a little bit higher rates and everything good, or a recession and lower rates? So that is always the game that they are playing there. But let's discuss the impact on the stock market. Immediately, as Powell suits everyone, there is a rally, stocks go up as the Fed said that recessions aren't alarming, everything will be good, and maybe even again, as Powell likes to say, that everything is transitory, so also the impact of tariffs on inflation. And immediately, if we look at the stock market, 1% up, what you could call rally or not, but if we look at the risks, do we know that there are risks? Nobody wants to talk about risks because that leads into panic and different behavior than one would want for growth. If there is a recession, the answer is lower rates. That's the same for the debt bubble, for the overvalued stock market. You need to lower rates, push financial assets higher to keep it at these levels. There is no other. However, on inflation, tariffs, then rates should be higher to, let's say, ease spending in order to prevent inflation. But this is now a different factor that might even lead to stagflation because there is less spending on higher prices, and that's a very, very tricky one. But anyway, we don't know what risks will materialize where, but what we know is that the risks are piling for sure. If we look at the growth of the EU area, it is close to zero. However, the EU is not borrowing as much as the US government. If we look at the share of nominal GDP, 19% of the US GDP is government spending. And government spending is based on 27% of borrowing on 7% likely long-term government deficits. That's the current situation, but nobody cares about these fundamentals. Nobody cares about what will happen in 2032, 37. Everyone is so myopic because nobody wants to look. We see the debt, it went from below 20 billion 2017 approaching 40. That's the US government debt. Stocks are exploding on valuation, and each time that happened in the past, it wasn't a pleasurable ride going forward. However, stocks might go also up on money printing, and that might be the reason for stocks to stay at these levels and wait for the fundamentals or inflation to catch up, because at these levels, at these interest rates, this would be a fair valuation for the stock market. But if this happens, then yes, then stocks might also be at 10,000 over the next 5 years, but that would be still zero real returns, as this would likely be pushed up by inflation. However, I do really think that all these issues will likely be solved with money printing. As soon as there is the recession, they will lower rates, likely also possibly print more. You see the political pressures there. So from a fundamental long-term perspective, this is what will most likely happen. So from that perspective, yes, the market might also be fairly valued. However, there is a trick here, and we'll discuss it. Because if you look at the market, I would say that all else equal, with current interest rates at 4%, maybe going down even to 3%, a fair level at these earnings for the market is 4,000 something. Because Wall Street is predicting huge growth in earnings, but earnings cannot grow 50% in the next 2 years. That's crazy. Because also, if I look at reality, before the pandemic, 172 going to 200, that's 15% growth. So that's not crazy growth that the market is expecting. So I would say 10 years of flat would be all else equal. However, if this is solved like this, then we have this investing situation. If the Fed prints, we have inflation, real returns will still be zero, but stock market returns might be positive. However, purchasing power will go down, as we are seeing in Europe, and things like that. So when it comes to investing, I have to invest in a way that if Powell goes like this, I get my 15%. And if Powell doesn't go like this, and let's say the market is zero or negative returns crashes, I still make 10 to 12% from value investing fundamentals. And that is exactly what we do on this channel. We'll see what happens. We cannot predict. It's very likely the solution is printing. That has been the case in history. However, then owning real assets at a fair price is the best way to go.